Have you ever wondered why the market always seems to move exactly to the level where everyone has their stop loss, only to reverse right after? It's not a coincidence, it's the market going for what we call liquidity pools, the invisible zones where orders are waiting to be collected. Liquidity pools are one of the most important concepts in smart money trading. They represent areas on the chart where large amounts of orders are concentrated. These orders can be stop losses, pending orders, or breakout trades waiting to trigger. In simple terms, there are pockets of liquidity, and the market is always attracted to them. To understand it, imagine a sponge trying to soak up water. It doesn't move randomly. It moves towards where there is the most water. The market does the same. It moves toward the zones with the most orders because that's where it can execute big transactions efficiently. Liquidity exists both above highs and below lows. Above equal highs, you'll find buy-side liquidity, a cluster of buy stops from trades who are short, and buy stop orders from breakout traders. Below equal lows, you'll find sell-side liquidity, sell stops from traders who are long, and sell stop entries from those waiting for breakdowns. Every candle on the chart is a part of a bigger story, a constant hunt for these pools. Institutions or smart money use liquidity to fill their massive orders. They can't just enter anywhere. They need to find enough opposite side orders to match their size. So they push price towards these areas intentionally, grab that liquidity, fill their orders, and then move price in the opposite direction. This is why the market often takes out obvious highs or lows before changing direction. It's not random, it's how the system works. Liquidity provides fuel for movement. Without it, the market will stall. Think of it like refueling a car. Before continuing the journey, the market needs to fill up its tank, and it does it by collecting liquidity. Liquidity pools can form anywhere, but they're especially common in areas where traders make the same decisions, like equal highs, equal lows, trend line touches, or consolidation zones. Wherever traders cluster orders, smart money sees opportunities. Let's use an example. Imagine price is moving upward and forms two equal highs. Retail traders see that as resistance. Some place short positions there, while others put buy stop orders just above, expecting a breakout. That combination of stop losses and breakout entries creates a liquidity pool. Smart money pushes price above those highs to trigger all those orders, collecting the liquidity, then reverses the market in the opposite direction. The same happens below equal lows. Traders see a strong support, go long, and place their stop losses just beneath it. Smart money drives price below that level to grab those stops, fill their buy orders, and send the market up again. Liquidity pools don't just form at an extreme of the market. They also build up inside ranges. When price consolidates, both sides of the range collect liquidity over time. Once enough orders have accumulated, the market will break out. First, to grab one side's liquidity, then move in the opposite direction. This is what smart money calls engineered liquidity, a deliberate built-up design to trap impatient traders. It's not manipulation, it's mechanics. The market can't move without order flow, so it has to seek these pools to find it. Here's a real-world analogy. Imagine a fisherman throwing bait into the water. The fish gather around, and once there's enough activity, he casts his net. Institutions do the same thing. They let retail traders build positions, cluster stops, and create liquidity. Then they strike, collecting all those orders at once. This concept explains why chasing breakouts so often fails. When retail traders see price breaking and a key level, they rush to join. But more often than not, that breakout is just the final liquidity grab before reversal. The true move happens after the pull is taken, not before. Liquidity pools also play a key role in the market cycle. Before an uptrend, smart money usually collects sell-side liquidity, stopping out long traders and filling buy positions at a discount. Before a downtrend, they grab buy-side liquidity, stopping out short and filling sell positions at a premium prices. You can think of liquidity as the heartbeat of the market. Each move up or down is just the market seeking balance, shifting from one pool to another. Once a pool is taken, the market moves towards the next. For traders, identifying liquidity pools means anticipating where the market is likely to go next, not because of indicators, but because of logic. If you can see where liquidity rests, you can see where price needs to go. So, how do you find these areas? Look for equal highs or equal lows. Look for tight ranges before major news events. Look for levels where many traders will place stops or breakout entries. Those are the hotspots. Once you've marked them, you don't trade into them. You wait for price to reach them, sweep them and show confirmation, like a change of character or displacement. That's when you know the liquidity has been collected and the real move can begin. Liquidity pools can be small or large, but the principle is always the same. Price seeks liquidity to move efficiently, whether it's 1 minute chart or a weekly chart. The market behaves like the hunter. It moves from one pool to another in search of fuel. So let's summarize what we learned today. Liquidity pools are zones where stop losses, pending orders, or breakout entries accumulate. They form above highs and below lows, inside ranges and around key levels. The market is drawn to them because they provide the liquidity needed for big institutional orders to be filled. Once the liquidity is taken, the market often reverses or continues its true direction. So the next time you see price approaching a level that everyone is watching, remember this: that's not just resistance or support, it's liquidity. And the market will always go where liquidity is, because it's where the money is.